Thanks for your time today, Angus. Firstly, let's kick off, I suppose, with a view of the PMI data we had coming out today. China sitting at 49.8, still below 50. And then, of course, you had the EU data, the September market PMI sitting at 46.1. Slightly up from August, both those numbers slightly up from August, but still overall, you're looking at a pretty bearish macroeconomic environment. Let's bring it back down to Africa. Your view so far on the impact it's having in sub-Saharan Africa?
Well, I think really the PMIs really are disappointing. What we have is still in the Eurozone this complete inability of the political leadership to resolve the crisis, and that's having an impact on the manufacturing, the services sector in Europe. And given the trade links and the capital flows that come in and out of Europe into sub-Saharan Africa, it's a major concern that we have. However, having said that, growth still remains reasonably robust in sub-Saharan Africa, and we see that continuing for the foreseeable future. But one area of concern over and above what's happening in the Eurozone is what's happening in China. As you mentioned, the PMIs there, they're relatively weak, and any hard landing in China is obviously going to have an impact, a major impact on what happens for demand for the resources coming from Africa.
Which of the countries that you look at in sub-Saharan Africa would you say are most resilient now in light of the slowing macroeconomic environment, and particularly in light of the fact that, of course, there'll be slowing demand, and we've already seen that evident for exports, particularly in the raw material space?
Well, I think Ecobank is operating in something like 33 countries across what we call Middle Africa. So we see a large diversification in growth performance in the countries that we operate in. For example, Sierra Leone this year is probably going to be growing at around 35–40% in real terms. That's largely because of the introduction of a large iron ore mining sector project. But even after that tails off next year, we've got strong growth of probably around 10%. So the resource countries like Sierra Leone, like Nigeria, like Ghana, growth will remain resilient, we think, going into 2013, around about 6 to 7% in real terms. And that's largely driven by ongoing demand, global demand for the resources coming out of Africa.
What is your, you must have a base case for China right now and a base case for Europe, and I suppose you'd also have to, you can't ignore America. What is your base case in terms of those three regions and growth that you're looking at this year and next year?
Well, I think for the last 4 years, pretty much since the crisis came and visited Africa, the global crisis, what we've seen is growth remaining resilient, holding up at around 5% or slightly more. We see that continuing over into 2013 from 2012. And the impact of a slowdown in China, as I mentioned earlier, obviously would have a negative adverse impact on sub-Saharan Africa, but not for all countries. But also more fundamentally, if there is a prolonged situation that develops in the US. We have the presidential election coming up in early November. We have this fiscal cliff event at the end of this year, where if there is some significant opportunity for the policymakers in the Congress to move back from that cliff event, then I'm sure that we could see some rebound in the growth, or a strengthening of growth in the US, which would obviously be very positive for global demand. So if we have some level of realization within the US authorities that there can be a step back from what could be a very calamitous event, then obviously the repercussions on Middle Africa, also the global economy, would be very positive. So that would help support growth of around 5.5% in real terms in 2013.
Let's get your views on Nigeria, because it's Independence Day in Nigeria today. And of course, at the same time, like South Africa, Nigerian government bonds are also being included in a government bond index, the JP Morgan Emerging Markets Bond Index. How is this going to impact the market? Firstly, from a sentiment point of view, and then from a capital flows point of view.
Yes, I mean, it's a great day for Nigeria today, Independence Day, as you mentioned. And with that, also we have Nigerian bonds for the first time being included in the JP Morgan Emerging Market Government Bond Index. And I think what we've already seen is some level of global investor interest buying into some of the securities that are on offer in Nigeria on the secondary market. And also they'll be participating in primary market issuance auctions. So at the moment we have around about $400 million thereabouts of secondary market activity in the Nigerian fixed income space. Largely that's driven by the sovereign bonds that are on offer. And once we have this influx of new investor interest, this new capital flow coming in, then we see some level of uptick in that, round about between 50, possibly more $1 million activity per day. But we've got to also remember a lot of the local investors are buy and hold, so the inclusion of Nigeria in this new index isn't going to have a significant impact on them. I think what the main impact will be a deepening of the liquidity pool in Nigeria, which is positive for the capital market development, but also for the economy in general, because if we've got increase in demand for these sovereign bonds, it allows the government to step up to the plate, so to speak, to provide more supply, increase the supply pipeline for the bonds, which will in turn provide more financing for the government over and above their oil revenues that they get. It adds another stream of financing to them for much needed infrastructure development throughout the country.
Thank you so much for joining us today, Angus. Great to have your views on the show. Angus Downie from Ecobank joining us from London.